And joining me on the podcast right now, and of course, in true Technicolor, you only capture the essence that is Paul Hill on video. So check it out. Full-time investor, equity analyst. You all right, fella?
Yeah, morning, Justin. Long weekend, so we can take a bit of a breath. I know, it's
not going to help the economy, is it?
No, well, I don't know. Actually, depends on what we all spend on
in
with,
fact,
with our barbecues.
Leisure hospitality is fine. I've got a
right.
couple of those stocks, so I'm okay. Do you know what? I was watching sort of CNBC yesterday, and the American market's having quite a volatile time. And with my sons, I'm trying to get him into investing. So I'm using what's called sort of a free trade app, which is dealing is free in US stocks, in fact, UK stocks as well. And so I get them invest in 5 stocks. They've been holding them for a couple of months. And it's a rough time there. And it's funny because it's only a couple of stocks holding the market up there. It seems like Apple, Microsoft, and in fact, my youngest son decided to buy Philip Morris this week on this podcast, and that's hell. And Berkshire Hathaway, he bought that. So and those 4 are doing particularly well, and Costco. But the others, everything else, are taking a massive hammering, and it's unbelievable to see that the S&P hasn't fallen, but just the size, I suppose, of Apple and Microsoft, this diverges the market. You don't see a true picture, but most of them hammered, like Facebook, Tesla, in fact, Elon Musk is selling about 4 billion of stock. But it's interesting to see, isn't it? When you look at indices, you're not getting a true picture at all. And I suppose, you've got to look at the companies you hold, because the picture is very different. The stories are very different on all of them, In fact, they're looking at McDonald's. That's done quite well as well. But yeah, very interesting. But what do you see NBC? Don't even watch it very often. They get the guys on there. Most of them just seem to be trading, They just jump in and out, in and out. I'm thinking, what are you doing? It's not the kind of thing that Buffett does, is it? Jumping in and out like that. So it's very odd, isn't it, the way they operate on that show there,
I'm glad to hear you've stopped trading now, which is obviously good news. But I'm equally glad that your young lad sort of portfolio is smoking on Philip Morris, so that's good. But you're right. I mean, certainly when it comes to sort of like the macro, I think it's really sort of reiterating what we've discussed before. You've got sort of like a consumer that obviously can be under pressure in terms of if they haven't got a job. In terms of particularly say in the UK, and they're on universal credit, they're really, really, really struggling. And then you've got sort of 70% of sort of the working population who have got a sort of like disposable income, and the flights and holidays, and even this weekend, I mean, the leisure sector is going to do sort of very well. So you've got a sort of two-speed economy. The underlying, they had some GDP coming out actually yesterday in the US. I don't know if you saw that. It was negative 1.4%. But I think really you just got to look through that. Underlying, the US economy was still strong, and a lot of business and private consumption was still motoring ahead. So that won't really derail the Federal Reserve from pushing up interest rates. And what's also hit meant from that is that the yield pickup on US Treasuries compared to, basically bunds and the gilts and the yen, etc., has meant that the dollar has gone really quite strong and is appreciated against most major currencies, including the Chinese renminbi. And it's up by about 7 or 8% this year on a basket of sort of major currencies. And I think the UK, I think sterling now is down to about 125, which is going to impact quite a few businesses, particularly if you're a UK company importing in US, effectively buying product from abroad and selling it into the UK, because that's going to be a tough one. But if you're an exporter, then clearly you're going to be doing very well. So it's a sort of like you've got to pick your right spots, no doubt about it. And when it comes to sort of like, inflation, I mean, it's 7-8%, etc. So it is pretty tough. And it's choosing those stocks with pricing power. And the ones which are holding up, as you rightly point out, are the likes of, Philip Morris, because obviously there's smoking. You've got, lots of sort of like the consumer health.
Vaping there into now as well, the big.
Yeah. Well, and also the sort of the consumer healthcare stocks. I mean, you saw Unilever this week putting up, saying it put its prices by 8%. Just to recover its sort of like costs. Yes, volumes are decreasing, but that's a huge increase. Reckitt Benckiser reiterates that as well. and you know, your healthcare stocks are another good sort of like safe haven. And one of my companies, one of the ones I hold, AstraZeneca, reported Q1 results very much in line, and I would class this as a sort of like a, you know, a fast-growing, high-quality GARP stock that actually is still reasonably, even though it's gone up. I mean, I bought it for about 70 quid, and they're about 105 now. And I would still class it as a sort of safe haven. I mean, it's on a PE of about 20, 21 times this year, EPS. But if you look at it on a PEG ratio, say the EPS is growing at the same sort of level, PEG's about 1. So it's around about fair value. I would still sort of like say there's good value and good upside in, you know, in AstraZeneca, and it's probably the UK's largest company at the moment. So it sort of like debunks that whole theory that elephants can't gallop, you know, sort of stuff. So yeah, I mean,
that's it. I mean, there's American stocks, you know, they are. I mean, you got $1 trillion market caps, and they are still sort of galloping. You know, it's that kind of growth that they've had. It's phenomenal. You've never seen big companies like that growing. You're talking like sort of, you know, mid cap, small cap growth, top line growth there on those. It's phenomenal. I know, unbelievable. But
yeah, but they can still have a bit of a bath. Let's be clear about it. You know, you had Google shares off for about 6 or 7% earlier in the week. They already bounded yesterday, and obviously, Amazon after the close was down 9%. Yeah, on the back of, you know, it had really tough comparatives from last year because things were in a lockdown, and then its online did really, really well. And that's seeing now slower top line growth, and also its cost base has ballooned out as well. So it's got to sort of manage those different variables, but it's still trading at a high valuation. I mean, you've got it's a big leap of faith if you decide to buy the shares even at current levels, and they're down sort of like, you know, 9%. But you're right. I mean, Apple's still very much, you know, sort of like on I don't know what the price earnings ratio is, but the last time I saw was high 20s. So it's still not cheap for a hardware software type of business. That's for sure.
But with Amazon, the advertising side and the cloud computing is still very strong. And the big hit they took was from investing in Rivian, you know. So
yeah, well, that's a one-off.
Billion, and exactly, yeah. I mean,
the shares didn't go down on that; they went down on the outlook and the costs.
Yeah. Because let's be honest, everyone, I think they'll still have that long tail from, you know, people change their behavioral habits during lockdown. They started ordering everything online, and now that's reduced a little bit. And like I said, do you know what? Of all the streaming services I have, this is one of the discretionary spends. You know, everyone looks to tighten their belt a little bit. It's just the media scare, you know, over inflation, everything's going up. So everyone starts to look at their own finances. And I thought, if I'm going to get rid of one of the streaming services, probably going to be Amazon Prime first, you know, and even though you get free delivery on that, so they may take a hit there, and of course that just falls in line with, you know, going back to the shops rather than shopping online. So yeah, it's unbelievable. You see these companies, you know, that they think you can't be beaten, they're unbelievable, they're going to grow forever, and all of a sudden, you know, in a couple of quarters it can turn, can't you? Think, oh, hang on a sec, it is turning.
Yeah, I mean, I would say most of the, you know, sort of like if you're in a discretionary high cost type of product that serves sort of like, you know, the lower, well, effectively lower income demographic, then actually, you know, you're basically, that's a difficult place to be, particularly if it's more impulse orientated. I mean, you know, so I would say stick clear of that. And Amazon will definitely, it sells a lot of stuff, you know, that is essential and non-discretionary, but equally it sells a lot of impulse because people, you know, they've taken, as you say, they've taken Prime, and they, you know, they go on for a pair of socks and buy some shorts and a shirt, you know, at the same time. So they just think, well, okay, that looks nice. It all goes well, and they and maybe they don't do that as often, I don't know, as they did before. Yeah. So yeah, I mean, you've got to choose your right spots, in my view. But even if you do choose you choosing your product doesn't mean you're immune to it. I mean, another one I've bought recently is Aveva, which is that sort of like, you know, the construction IT software business, the CAD CAM, and also it's got the hosting product of it, and it does sort of like this for industrial software. So it helps companies build factories and processing plants and mines and all this sort of. It's effectively going to be a major beneficiary going forward of the shift to the you know, sort of the metaverse, because it's all digital twins, etc. Anyway, they're transitioning from a a perpetual license model to a SaaS, and they want to increase that, and that's going to hit some of their top line or headline growth for this year. But also they're seeing higher costs, so their margins are also going to be depressed. So it came out with a profit warning for this year, which was a bit of a pain. But the shares were down 30%, which actually I thought was not bad. Sorry, it was down 20%, which actually, in all the grand scale of things, and they're up again today, actually. So overall, they're probably just down about 15% from where I bought it. So all in all, actually, it wasn't a bad result compared to people like Netflix and, you know, where PayPal have been and this sort of stuff. So, you know, I bought for the long term, but it doesn't mean, even if you're in a sort of like a, you know, quality GARP stock, that they can't sort of drop the ball and have difficulties, because that one is. But if you buy for the long term, and as you rightly say, don't trade, then effectively time is on your side. And you can, and this is really, I'm just treating this as noise. It's short term, you know, readjustment to the business, but longer term, you know, the direction of travel for this is going to be up. And I could see this do double-digit top-line growth and 30% EBIT margins for a long, long, long time. And eventually it will get bought out, probably by its biggest shareholder, which is Schneider Electric out in Germany.
Yeah. Do you know what? You know, the market at the moment is very unforgiving unless you know, post an out-and-out, you know, exceed on everything. You know, you can actually be in trading line and it'll go down in this market. You know, it's really hard. And in fact, talking about the recurring, you know, software as a service models, Trufin had financial results out. And
what were they like? What were they like?
Yeah, good. Listen, the revenue went down a tad, but again, they're still transitioning to, because Sataga, for example, that's a blow away deal. You know, it's phenomenal. You know, Lloyd's, biggest UK retail bank, they signed a deal with those software as a service. And they were initially lending on their own book on Starglow, but now it's gone to completely software as a service. And so revenue's gone down top line that, but you have to understand the upside potential is huge. I mean, 13 million top line revenue this year. They made 8.4 loss, but there's 4 companies here. 2 are now profitable, but the 2 exciting companies, the ones with huge growth potential, PlayStack and Satago, you know, they are motoring and they're now funded to profitability. They raised 10 million in March. But if you look at the growth expected here on Trufin, so we've got 13 million this year. That's got up to, you know, Satago kicks in this year, and PlayStack's got several titles they're launching. Forecasted revenue for this year is 20 million. So that's 53% growth. And then on top of that, 74% growth top line the next year, the following year. So that's when it kicks in. So you've got to, you know, it's going to dip a little bit on that transition to software as a service, but the upside is huge on Trufin, you know. And like I said, I think they'll.
Are each of those divisions big enough to actually spin out at all?
Yeah, I think
Satago and PlayStack.
Let me just bring, like Oxygen, for example, right? It's one of these very sensible. Let me just scroll up here, and so they provide sort of early payment systems to the public sector, and they are the market leader there, and they're the first year of cash flow positive status there. And Virtus as well is very sensible. It's a bespoke sort of business for loans to enable independent financial advisors to sell their business on. So they need, if independent financial advisors are retiring their business, want to sell it somewhere else, the person wants to buy it and get capital through this. Those 2 companies there have strong visibility, very sensible. They're never going to blow out of the water top line growth wise, but very sensible. You know, I think it's Oxygen. It's something, it's very high percentage. Like 90% of its revenues have like 5-year contracted forward-looking revenues. So it's good good visibility on that. So those 2 there, I mean, I don't know what they do with that, because there are sensible businesses that will grow slowly, quietly. In fact, Oxygen looking at 20% top line growth year in year. So it's not a slow grower, but just a very sensible business. So yeah, I think there's lots of optionality here. I don't know what they're going to do, but the 2 exciting bits.
How much would you, on the sum of the parts basis, how would you value this? What would you come up with?
Well, the brokers are forecasting Satago pretty much to be 3 times the value of Trufin. So, and James
over 200 million.
Yeah. So James honestly believes, he said to me, that it can be.
Is this the CEO?
Yeah, of Trufin. It can be. He said it can be a unicorn. He said, we've got the Lloyd's deal happening. The interest we have from other major players in the area there is huge. And I'm talking about, he said, and these are companies, he said, my mother would know. My mother's not a fintech expert, but their household names are now looking doing deals with Targo.
So how much would you value it though?
But I don't know. I mean, all I'm going on is the broker notes here. Don't
you think you should value it yourself on some of the parts?
No, well, no, it's hard. At the moment, it's all
just didn't do it.
I know, but I look at the forecast of broker. No, I do with all companies I do, but with this company, it's very hard because
it's just some of the parts.
No, but how do you know what Stark will do with Lloyd's?
No, you just assume you're making assumptions.
Again, assumptions. I know it's assumptions. Yeah, it's assumptions, right? But listen, that's all you can do is say, hey,
yeah, that's fine. So do it.
So what I normally do, okay, is I will look at what the brokers are going with. I'll ignore that. And if they're doing like 50, 60% top line growth, I'll say, I'll ignore that because if they miss that, it's going to take a big hit. So I always try and look at top line growth, 20% maximum, and I see what the valuation is from there. And so as yet this morning, I haven't gone through the figures on
okay, Trufin, next time, 2 weeks, you can tell me what your sum of the parts is then, because I mean, it does look extremely undervalued, but I'll be more swayed by your view than what the brokers said or through what the CEO says, because you know the business in and out, and you'd put some sensible valuations on it, and it's on about just less than it's about 80 mil market cap. Yeah, so I'd be interested to hear. I'd be more interested to hear your thoughts than somebody else's.
Let's do some of the parts right now then, okay? So let's do some of the parts right now. So they got 77 million market cap. They got about 15 million in cash there, okay? So that's about 16 million.
Now, what's your net debt though?
They're doing about 13 million revenue. Got 20 million this year, so 5 times that. On software fintech is not a stretch, is it? So
okay, so sorry, that's Targo, is it?
That's Trufin as a whole, the 20 million in total this year.
You can't do that though. Just okay. Well, anyway, have a think about it before you bolt it. All right. To some of the parts, because you'll have different multiples for different parts of the business, because some of them will grow faster. You've got to take your net debt off and just adjust it for the. Because it owns what 80% of Stargo rather than the whole 100%. So you've got to adjust it for all of that. Anyway, that's something I'm looking forward to in 2 weeks' time.
Yeah, well, the brokers now have a target of 120 on it on these financial results, but so I'll look into that. Hey, listen, this morning I've been hanging out the washing. I've been taking the kids to school. I've had a car age incident on the way to school. I'm gonna have to I will get into it. I'll get back to you on it. But,
no, great, excellent. Okay, just moving on before we get into your washing. We've got the cost of living crisis. Yeah. Well, I've actually invested in a company this last 2 weeks, which hopefully will be a play on that one. And any ideas?
I have no idea. It could be. Is UK listed?
Yeah.
What size is it?
About $1 billion.
No idea.
Okay, moneysupermarket.com. It's come off from about sort of like 4 or 5 quid about 3 years ago. It got
How many
battered.
stocks you got now?
Hang on, just let me finish. It got battered about 2 years, over the last 2 years, because effectively, because of the number of things, the pandemic has stopped people traveling, and obviously it sells travel insurance or helps companies sell travel insurance. And that's obviously, coming back. And then you've had the FCA, the financial regulator, putting controls or changing the law for selling financial insurance, warranties and stuff like that, and home insurance and car insurance to change the law so that somebody like Aveva, who are the insurer guys, can't sell a policy to a new customer at a different price to an existing customer. So that's obviously upturned the whole and taking competition out of the insurance, which is a temporary phenomenon. But the really big issue is that obviously you've had that blow up in the energy market, which has taken all of their sort of like intermediary revenue, sales revenue away from helping energy companies to effectively sell their products. So it's on a sort of like really low, sort of like, historically sales and profit at the moment, temporarily depressed, whilst competition in those areas then come back, and travel is already coming back. The shares are about 175, etc. But going forward with the cost of living, there's going to be more and more people who are going to need price comparison websites to get the best product, to get the cheapest product. And I can see these be a beneficiary. And when you actually look at the numbers, I mean, it's pretty liquid stock. But when you actually look at the numbers, you had Future Group, which is a big business, bought GoCompare.com back in November 2020 on about 20 times EBITDA. These ones trade at current levels of just less than 9 times EBITDA, so less than half the valuation. They pay about 6% dividend yield. The balance sheet is absolutely fine. And I could see this being a really good, strong recovery over the next sort of 2, 3, 4 years. And a lot of that is also self-help. So not only do their end markets should be getting better, but they're fully integrating all their IT platforms into one data system. And rather than actually become a price comparison website, in 3 or 4 years' time, these guys could be effectively, a data aggregator and also advertising platform. So I think they've got lots of different levers to pull here, both on a taking cost out by leveraging all those IT systems to get onto one platform, but also just selling new services and better. And of course, being a brand, it's, one of the strongest brands in the UK. Then they've got first party data aggregation. So they don't rely on cookie tracking from the likes of Apple. These guys are actually, they know their customers. They've got that customer data. So they're going to become strategically more important for advertisers, particularly when Google rolled back its tracking as well in subsequent years. So, who knows? It's not a slam dunk, but I think this is as good as any. So, I picked up a full position. And I think they'll be a beneficiary going forward of the tough areas because people, let's be clear about it, people still going to need home insurance, car insurance. These are not discretionary items. They're mandated, certainly on the car insurance. They're still going to need travel insurance. They're not going to go to, in fact, they might even need more travel insurance because, as we come out of Brexit, anybody going abroad is going to need travel insurance. So that should sort of come back really strongly. And the energy sector will return. It's zero sales at the moment. It will return once the wholesale gas prices, or electricity prices, start getting below the price cap. And it hasn't happened yet, even though the price cap increased in April, but it will definitely happen. That will come more in balance in October when either the price cap goes up or wholesale prices come down. So this is, I think this is a good steady Eddie type stock that could be more than just a steady Eddie. It could actually double your money over sort of 3 years. So something to look for.
That's come down, isn't it? July,
yeah, it is. Yeah.
From 2019, it was at over £4 a share. Now 173.
Yeah. And it's got a sound balance sheet, and it should do well in this more austere environment. It could. I mean, I wouldn't be surprised.
So when you're looking at the company of that, for example, obviously you need growth, okay, and seemingly on the macro issues there, you're right, it should grow. But are you not worried? If it doesn't get it right, it won't grow. It'll keep going lower because because that's the thing, isn't it? I remember talking about RDT.
You can worry about everything, Justin.
No, do you remember Rosslyn Data Technology? I got in, and you got in, and the figures were all good, and you liked it and all that stuff, and you kept saying, no, they'll get the growth. But I said, my concern was there wasn't any growth there, and I've said a couple of times, I prefer to be a bit late and I have some evidence of growth rather than jumping, hoping the growth will come. Now, this could be the same there, couldn't it? Because let's be honest, comparison sites. Compare them. There's plenty of them, isn't there? So why is this different?
There's only three, really. There's Money Supermarket, Dom. Go compare, and then Money Saving Expert. What other ones are there?
I know what I'm saying is, listen, your thesis is very good. Of course, it should come, the growth, but sometimes the hope of growth coming and it not coming can be a big gap between that. You know what I'm saying? So sometimes it's not better to wait for the growth.
You can do what you want, Justin. All I would say is that, it's convinced me sufficiently enough to put my money. You can put hard and fast rules in place for all types of scenario, but I think you've just got to flex it. You've got to decide on yourself. Do you think growth is coming? And I personally believe there is. You can either do a show me.
No, I'm just giving you a hard time to give me a hard time of truth, then. So I give you a hard time on everything now.
But I mean,
listen, that's investing on hope, though, isn't it? Rather than
figures.
It isn't. You're a figure man.
It isn't investing on hope. It's basically investing on what you think is happening. More than 50% probability, I believe this business if I was going to go to a court of law,
I know that's
if I was going to go to a court of law, I would say this is higher than on the balance of probability it's going to grow. I would say this is beyond reasonable doubt that it's going to grow. And on that basis...
You have to prove it, though.
No, yeah, I know, but hopefully...
you have to prove beyond reasonable doubt. You can't believe it.
Every investor
every investor goes into a dragon's den, believes their business is going to be the business. It's going to be the one. They all believe that.
Yeah, I know, but Justin, you can basically say, well, I want to see, and you do nothing because you're just waiting everything. You have to make up your mind in your own view about what's going forward. And that comes down to growth. It comes down to... I
completely disagree with you. Absolutely disagree with you. Because you don't have to make a move before you have proof at all. Because you may never get proof. And the thing is, you're better off being a little bit late and right than early and wrong. Absolutely. Don't you think that?
We're different investors, mate, because if you do that, it's all the shares will have moved up. Yeah, most of the upside is. Let's be clear about it. Okay, let's turn the clock back 2 years. Okay, at the start of the pandemic, there was categorically very little medical scientific information that we would get vaccines.
No, hang on a second. It's a different subject.
We were investing on hope.
I didn't invest in any vaccine companies on the hope that a vaccine would come.
No, not vaccines. Not vaccine companies. It was basically...
You're a long-term investor.
We were investing on hope and heart rather than head and medical science when effectively at the start of that pandemic, because you would not find a doctor, a medicine, a scientist saying that we were going to basically come up with vaccines at 10 months. You've got to basically have a view yourself on financials, on your expectations for that company, on the expectations for the industry, do a valuation. And if you've done all that and you're pretty damn certain that effectively beyond reasonable doubt that this is going to be a higher share price, then it's happy. It's happy days.
I agree. But listen, as a long-term investor, if you're saying there, right, basically you're hoping it'll come back. So you're buying now before you get assurance of that. But if they're going to be an improving business for years and years, doesn't matter if you're a couple of months late, is it? Or, if you're a couple of months, if you wait a little bit, if they're going to improve for years and years.
Look, mate, this is a stock I feel pretty comfortable about, so I'm investing in it. Okay, there's no hard and set rule. You're trying to put a rule on certain things that, frankly, are uncertain because a lot of companies, yes, they may get growth, but they may not, and therefore you decide not to invest in. Others, you think actually there's a really good chance the market is not pricing in what I believe is their growth trajectory going forward, and therefore I'm going to buy because I think it's a cheap stock.
Yeah,
I actually think private equity could take out moneysupermarket.com in a heartbeat, just because it's generating so much cash. It's got a strong balance sheet, and they'd leverage it up because on a 6% dividend yield, this generates a shed load of cash, and it's only on, as I say, it's less than 9 times EBITDA. I mean, these things you could easily say should trade at 14, 15 times EBITDA, which is a significant upside. Anyway, regardless of that they are like the valuation is, like you say, you're basing it on the valuation there, and then of course you have to pair that up with what you hope will happen. But there is. This is what I said about Trufin.
What?
Which is what I said about. Anyway, it doesn't matter.
We'll go back to. I can tell you net debt, Trufin, and all that stuff. But listen,
yeah, okay.
Again, wait. No, but the thing is, how many companies, actually perform out of the box when actually people are looking at net debt when it's not really an issue? If net debt is an issue, fair enough. But it's not, is it? So companies rise on growth. Full stop. Pretty much, they don't rise on. It's a decent valuation. They've got to have the growth there. If you look at anything, if you look at the stats, there's a good guy on.
Okay, mate,
on
your lad.
Brian Feraldi. No, hang on a sec. There's a guy called Brian Feraldi on Twitter. It's very worth looking at, and he's looked at all the moves in stocks over the years, and it's something like 85-90% of companies move on growth. And
you're right. Most move on growth. Totally agree. Anyway, let's move on.
If debt is an issue, of course, that can drag it down. Let's
move on. We've got a difference of opinion, which is fine.
Okay, hang on a sec. Let me finish. Don't move on. I won't move on even moving on. If debt is an issue with the company, yes, it's an issue. But if it's not, then you've got to focus on the areas that, you know, are most important, which is growth, of course, you know. So, yeah, so you highlighting what's the net debt in Trufin, which is not really an issue. So what's the point of looking at that too much? Okay, if it was an issue, you may want to focus on it too much, but it's not. So, you know, so there we are, you know. Just trying to pick holes.
Debates. I love our debates.
Just try to pick holes. No, but it's the same with, you know, it's the same, you know, you've got valuations and stuff. Like I said, we've got, you know, RDT. That's a company that could be very good, you know, and look at the valuation now. It's compelling, but they need that growth there. And if they get that growth,
okay, let me fill in the blanks on a, you know, Rosslyn, okay, RDT. I've owned that for what, I don't know, 2 years. I bought in at 5p, and I've hoped that this one would actually grow in its underlying business. And unfortunately, my view at the time, which was, I've spoken to the management team, I know the business inside out, and I think the scenario, the setup is perfect, was frankly wrong, because it hasn't been able to do that yet. In fact, the software that they sell, unfortunately, because it's more enterprise and big ticket item, hasn't yet been implemented, because it went first tier, which was Zoom and communication technology during the panics. Went second tier, which was front office, i.e. such that, you know, helping people digitize and clouditize. And they haven't yet really sort of like large corporates push the button on these type of, you know, sort of like master or supply chain, sort of like master supplier type data aggregation and AI, and that's where they've been struggling to actually sign, etc. Anyway, they're going through a strategic review. There's plenty of hidden, you know, value within that. And I mean, I've spoken to their largest shareholder, the different fund managers, both Brendan Goulston recently, which is the video, have a look at it, and then recently, about 3 months ago, Ken Wotton from Gresham House. And both of them sort of reiterate what I think is that the business is worth at least 5p, 6p, 7p, and probably a lot more than that. And they're unbundling and they're looking at sort of like realizing that value. So all I would say is that if I didn't have the shares, would I buy them at the moment? Probably not at the moment, simply because my view is less certain than it was at the time of the pandemic in terms of their growth profile. But as I do own them, there's no chance I'm selling them, because I actually think they're a strong hold, because I think there's a lot of inherent value in there. And it's a more show me story. Whereas, you know, I would say with Money Supermarket, Tom, that isn't a show me story, because I'm flipping confident about it.
You know, I agree. Listen, Money Supermarket's a more mature business. Of course, it's got massive end markets there, and it will probably grow. There's more chance of that growing, of course. Now, Rosslyn Data, I think, I liked it at the time. I bought in, I researched it, hoping that growth would come, and it didn't come. And I jumped back out and said, they've got a sales guy in to improve the growth. It's not yet coming. It's a sit and wait story, like you say. Absolutely agree. But, you know.
You have to say it's not hard and fast fuel. It's basically what your view is for money, for one, like moneysupermarket.com, which I'm happy. And then with Rosslyn, you just got to face it. Occasionally, you're flipping wrong. Yeah. I mean, 1 in 3 of my theses are wrong.
Yeah, but hard and fast rules, you can do that. I mean, all companies, in fact, you know, I just watched a video a while back, but Buffett saying there's no value, there's no growth companies. You should look for everything in all companies, pretty much. You know, they should have growth. All companies should have growth, pretty much, decent companies, and they should be decently valued. But, you know, it's true. Like I said, they're different animals. Of course, Money Supermarket's gone through a bit of cyclical downturn, COVID and all that, but that will return. Like you say, if they are one of the dominant, you know, comparative websites, of course it'll return, and that growth will come with a newer business, a smaller business like Rosslyn, who haven't got multiple revenue streams. They, you know, they're doing a bigger hit if they don't show that growth. But of course, all companies need growth. That's keep it simple. But growth, you know, is up there. Is the most important factor when you're looking at growth companies. Growth has got to be there. You know, it's got to be there. Otherwise, it's not there, dead in the water. For a while. I'm not saying they won't do it. I mean, I watch Rosslyn Data and I look at the updates all the time, because I think if they get that growth, it's going to motor from this level. Because
it is. Yeah, I agree.
10 million, you know, it's, and they're in a good area. They seem like a professional business, and not many businesses at that level, you know, show that kind of corporate professionalism. You know, professionalism. I like them a lot, but it's just that growth, isn't it? That missing factor is growth.
Well, okay. I mean, let's on that theme, right? We've got 3 fallen angels, which all came out with news. And some of them have gone through the pandemic and haven't been able to grow, but now they're coming out and growing. And others have just been doing brilliantly and are still fallen angels because of the sell-off. So let's start off with the easy bit, the last bit, which is Kate Box. They came out with a trading update. Really it was just after Easter, and I mean their business is literally like last year just absolutely flying. Turnover was up 50% like for like. Sorry, it was up 50% year on year, like for like at 12%. Net cash is at sort of like over 5 million, and the profits are powering up, and they're on track, you know, for this year to increase EPS by about, I don't know, 20% from 13p to over 16.3p. Cash again going up. And they're on about 13 times, you know, price earnings ratios going forward. So really good value, cheap company that is, you know, and I would class this one very much as a sort of like, you know, an affordable treat that people will continue to pay for. And most of their sales are just linked to people's birthdays, and it's very unlikely they're going to sort of like decide not to celebrate their birthday, even if they're sort of like, you know, struggling financially. So, you know, it's an affordable treat. It should do well, and I'm pretty certain it will, because, you know, the CEO Suk Chamdal is really passionate and is, you know, driving the business, and you know, their growth this year is, you know, sort of like already baked in just from new store openings, and it's got a big bank of potential franchisees who've already put deposits who are going to open up, and it's got rolling out its shopping centre kiosks, and also its outlets with Asda, and on the online side is going up by 27% at the moment, like for like, and it'll probably continue to grow strongly as well. So really, again, the business is doing really well and has sold off. It halved, in fact, from its peak, and really just on sort of like, you know, noise, nothing really substantive, because the numbers are just powering ahead.
Yeah, and no, exactly, it's a good growth, and so that's sell-off, and just basically down to sort of some errors in the accounting, wasn't it, or something?
There were minor things that a blogger pointed out. Anyway, the business is doing.
It wasn't affecting the actual, the figures or
no,
the cash flow or anything like that.
No,
so, yeah.
No, so that, you know, that it's doing well. And then you've got sort of like you've got another company that was actually impacted during the pandemic, and the one I've talked about is Manolete, which came out with a trading update as well for its year end, and it's received now that you know, the big payment that it said it was going to get. So net debt is down to a very comfortable 6.5 million, which is about 0.8 times EBITDA. So, you know, its balance sheet is absolutely rock solid. And it's seeing an increase on, you know, inquiries coming through. And I know it's gearing up in terms of, you know, recruiting specialist, you know, sort of like insolvency experts to handle the extra volume that it sees. And as you know, we've talked about, the government put in some pretty unprecedented creditor protection measures during the pandemic to stop companies going bust or going into bankruptcy. That ended on the 1st of October. It took a bit of time for the insolvency practitioners to get hold of those cases and, you know, get back to work. And now they're coming through to people like Manolete, who effectively buy those cases off the insolvency practitioners and then run with themselves. So I think this next 2 or 3 years, you've got a huge catch up of those, you know, sort of like creditor voluntary liquidations. That will drive the top line. It's a big sort of backlog, a bit like elective procedures. Plus, then, you know, you've got sort of like, you know, with higher interest rates and higher inflation rates, you're going to have businesses that are going to be, you know, having difficulty. So I think they're going to be it's a very good balanced business that will be counter-cyclical for people's portfolio. And I spoke to a really respected fund manager this week, George Ensor for River and Mercantile, and this is one of his top sort of selections as well. So, you know, he's a bright cookie, and I think it's going to do well.
Yeah. Do you know what? I wondered why. You know, BIOM, for example, the one I own, plastics, they've had a hard sort of 21, of course, but they still were flat, 5.7 million revenues and 8 million market cap, you know, and you know, they're going to get to profitability next year. But I just realized their customers are all in the US, which is good, of course, a strong dollar, isn't it, I suppose? So that's why they've had a bit of a bump at the bottom. But they've come down massively. Now they're expecting, like they said, they've had Q1 results out. They're expecting they're in line with guidance as it goes. Supply chains are sorted out now pretty much, or they're dealing with it. And so, yeah, so that's encouraging. I didn't realize that. I wonder if they'll build that in, because they haven't mentioned anything about that. But since the
foreign exchange tailwind?
Yeah, because they're looking at 43% top line growth this year. And like I said, you know, and EBITDA positivities, but yeah, there's that benefit of the strong dollar, isn't it? I suppose. I mean, you know,
that's another one to come back to me on 2 weeks' time. Then,
yeah,
you've got plenty of homework there, Justin. Sorry,
come back to that.
I know another one.
You know, genuine. I do, but all companies I look through. I mean, I haven't looked at the, you know, the net debt on Trufin or something like that. But I mean, I genuinely put. For our weekly webinars, put all companies through all the spreadsheet stuff. You know, anyway.
My wife thinks I'm a pain in the proverbial as well, Justin. So you're not the only one. But,
yeah, but
anyway,
the argument is the best thing about this podcast and video. If we just talked about figures and net debt, we'd get next to no views.
Exactly.
By the way, you had another third one, a falling angel, didn't you?
Yeah. No, I was just coming on to it. So Venture Life, when they're coming out with, they basically said this week that their audited results had been delayed by effectively their auditor, because it's struggling to be able to complete all the numbers and to sort itself out just on resourcing. So, you know, it's not surprised, because we had Easter there as well and all that kind of stuff. Lots of other companies have been having the same problem with their auditors. Anyway, to cut a long story short, they said their final results should be published imminently, really. I think it's the first week or second week in May. So I'm hoping to be able to touch base with the CEO, Jerry Randall, and the new CFO as well, sometime next week, to find out how the business was playing. But they've reiterated that all their numbers they've said before are absolutely fine for 2021. And you know, the big thing is let's see what the growth is going to be like in 2022. And I would say to investors, the biggest single takeaway that I got from when they put their indication for 2021 is that they saw a big step up between H2 and H1 of last year, as the world economy started reopening, as shops started stocking their over-the-counter sort of healthcare consumer products, etc. again, and were opening. And obviously their acquisitions have proved pretty successful as well at driving sort of top line growth. So you got much better top line growth, which is the thing you concentrate on. And then just on the margins, EBITDA went up from, I think it was about 14% first half to over 23% second half. And that just sort of sets the game, the sort of the benchmark for 2022 and 2023. And if this one sort of like, you know, continues to motor, then, you know, it's got a small amount of net debt. It will drive a lot of positive cash flow for the business, and it will re-rate, because I think it trades on, and I can't remember exactly doing the numbers, but it's sort of like a high 30 pence per share. I think it trades at sort of like 6.5 times EBITDA, and these things go for sort of like easily 15 times EBITDA or 12 to 15 times EBITDA. And when you do that,
thinking, or do you know that? Come on.
Okay, well, I know it, mate, because essentially Unilever bid for GSK's consumer at 20 times EBITDA. So if anything, I'm being a bit, you know, because it's a smaller.
No, I'm saying, are you sure they're on that multiple?
Yes.
Okay.
Why? Why'd you ask?
I'm just checking, you know, your figures.
I am absolutely 100%. Yeah. Oh. So essentially at about 39.40p. Yeah.
You're the figures, man. I got to keep checking with you.
It's about. In
fact, those metrics you mentioned there, very interesting. You see, top line growth, to me, that validates the product. They're selling it. There's big demand for the product. If their margins are also improving, they're not overly paying for that growth, which is very good two metrics. If you've got a company like top line growth, margins improving, what's not to like? Okay, so you've got to check out the net debt. But, you know what I'm saying? In that kind of situation, keeping it simple there, they are an obviously improving business, growth and margins, both improving. That's very good, isn't it? Those two metrics right there, you know?
Anyway, we'll get hopefully get an update either over some, by the time that'll be my homework. So when I come back in 2 weeks' time, I'll have an update on their audited their audited numbers. But just
you know what I'm saying, for people, it makes a lot of difference. If you're growing top line, but the margins are really slipping down smaller and thinner and weaker, then something's going wrong there. They're paying for that growth somewhere too much. And but if the margins are improving, the growth is going up. Well, that's a very improving business. It's growing and improving, and that's very important metrics. By the way,
18 months ago, the shares were a quid. Okay, 90p to a quid. They fell down to less than 40p where they are currently today. And they can easily get back to 80 to 100p, no doubt about it. And that would just be on a re-rating, never mind actually driving the top line growth. So again, another fallen angel that I'm very optimistic on.
And, sadly, in these markets, selling begets selling. A company will go down and people who are under research will sell because the share price is going down. No more reason than that. And then that gets a bit of momentum going, other people start selling. And so, it has to find that base level where you get the holders there that are confident in the business. There's no more selling going on. Really some good news. All of a sudden just pops because there's no supply and demand of shares, isn't it? Anyway, did you see, I mentioned last time, my last investment, the smallest company I own, Spaceandpeople, they come up with final results there. And this is a 2.8 million market cap company. And they rent out all the spaces in between shops, the big shopping centers or around about that. Now there's been a restructuring, and of course sometimes when you go through painful times like COVID, then businesses have to restructure. They're forced to, otherwise they go out of business. And so they did say this: they've taken £1 million of costs out of the business, and they bounced back. When you consider 2021, they were only open from April. And then November, they had disruption. December, they pretty much shut down because of Omicron. So they only had, not a full year, nowhere near a full year, 7 months? And so anyway, we are comparing to a like-for-like COVID year, of course. But 2.8 million market cap. The revenue in that 8 months was 4 million, okay? The good thing is they did a profit of 200K from a £3.6 million loss. So that's an amazing turnaround from a loss of 3.6 million to 200K profit. Net cash inflow of 800K. They've got cash and headroom. They've got C-bills loan there, so that's why the EV is about 3.1. But they've got 2.1 of headroom there, and they've expanded the venues massively. They've got a deal with Network Rail extended, with Landsec extended. They've also done a deal with ECE in Germany, and Germany, it's massive property. They've got about I think 58 venues there across 30 areas, 30 shopping centres. But I looked into the ECE estate, and they've got about 132 shopping centres, and they're across mostly in Germany, and they have expressed that they are going to extend the relationship with ECE. And now they're profitable. They also said they intend to start reinstating a dividend, not this year, maybe next year, but they're completely heading in the right direction, I believe now. And I don't think footfall may never get back to 2019, but it's certainly going to be close to. But they don't need it to, because their margins are better now with the costs reduced, and their venues are massive compared to where they were in 2019. So it's one of those companies, I think, we'll have to see that there haven't been any guidance on this until they do the next update. But I think they've really got their act together since the COVID shock, which frankly could have taken them under, and but now they've a huge bounce back, So tiny little market cap, but I think it could be quite exciting going forward. It's a steady business, and I think.
What I'm going to ask you, or do you want me to ask you in 2 weeks' time?
What is it?
How much is it worth? What's your valuation?
Well, I've said here, right, even if you put this on, let me just look at this. Even if you put this on 1.5 times sales, they are profitable, but as yet, that's not coming through. If you put this on 1.5 times sales, it should be 31 pence, and it's 14 pence at the moment. So it's no stretch there, and that's with, and that's on. What's
a sustainable price earning? What's a sustainable earnings?
Well, as yet, we're going to see yet, because it's hard to say that there's no forward guidance here at all, because they've got a bigger, larger estate of venues.
So what do you reckon they can generate on an earnings per share basis, mate?
I don't know, Paul.
Okay, right. Well, 2 weeks' time, let me know.
This is what I think. They're going to have EBITDA margins about 20%, okay? That's what it's going towards. So at the moment, they're about 13% EBITDA. So if you literally do even 20% growth, they can do a lot more than that. I think they'll get back to 7-8 million in top line here and do 20% on that, because but even on, a 20% growth on the thing, you look at 1.5 times sales, it's literally, we're way above where we are right now. I mean, they're about what, less than half, not even half of times, they're like 1 time sales at the moment. So it's I think it's gone from a period where it was a fright of them nearly going through to now them actually getting on board and get it right. So listen, 2.8 million, I could see this next couple of years being market cap 10 million. That stretch really. It's like,
okay, all right.
Yeah.
We've got a couple of other stocks that are really sort of primed for growth, and one of them is obviously
one of the I think if they release decent figures, the run rate compared to what they did in 2021 on the months they're open, then you talk about 7 million in revenue quite easily. But the estate is bigger now. They're doing pop-up retail, which is unabated demand for that. So I think they could do 7 million revenue this year and be profitable. And if they are, sub 3 million market cap,
Okay.
All right, mate. That.
Okay, bro. I would work out what the profit margins are, mate, and your EPS, and then drive a multiple on the back of it. And it isn't a 15 times EPS multiple, that business. It'll be sometime.
No, I know that,
less.
But anyway,
okay. You tell me what you think it is, mate.
Moving
on.
Even on 5 times EBITDA, we're talking a bigger upside here. 5 times.
Yeah. Okay. Fine.
It'll be a standout stock for this year. You watch.
Yeah. Okay. Good. Excellent.
And Trufin well.
Yeah. No. Good man. Good man. One which has really got effectively, and I know it's a bit of a pun, electric growth is Saietta. I mean, looking at this business, it came out with its prelims this week or last week, and it did 3.6 million of revenue, which is basically, before it's really sort of gets going from last year. But they reckon from 3.6 million, they're going to hit over 21 million. A broker does over 21 million for this year. I mean, it's a sort of 6-fold increase. And, the business is going to be is sort of on fire. And as we've talked about, in terms of they've accelerated their business strategy by leasing that factory up in Sunderland. They've got lots and lots of different sort of opportunities, whether it's in 2 or 3 wheelers, which is their sort of core bread and butter, whether it's in their marine, the propel, electric axial flux electric motors, or even in sort of now the heavy driveline, having bought the e-traction business, and they're bringing that production into Sunderland as well. So lots and lots of huge opportunities, and there was a pretty interesting market research coming out for Markets and Markets this week, which said that its in-wheel electric motor market was going to grow over 40% per annum. And given these are one of the sort of the leaders in that whole market, then it could do a lot better than that, no doubt about it. So, there's lots and lots of exciting things that this business is going. And just when it comes to sort of valuation, I mean, again, this is sort of this is because it's a fledgling market, axial flux electric motors. But if they only just won sort of 5% of the world market over the next sort of 7 or 8 years up until 2030, then you'd put it on a sort of I'd put it on easily a 15 times EBITDA multiple, which would give you a share price of 7 quid to 11 quid, compared to it's less than 2 quid at the moment. So massive upside with lots of IP. And I wouldn't be surprised also if somebody bought it out, because Mercedes picked up one of their competitors, Yasa, last year. There aren't that many companies with this type of patented, unique technology. So certainly one which is really motoring and continue to motor.
Yeah, I like that. I mean, I liked it anyway, and I looked at the broker forecast, and they are forecasts, let's be honest. But so you always take the pinch of salt, because businesses can run into sort of hurdles and obstacles. Doesn't mean the thesis is changed. Just means it may take longer. But yeah, like I say, 21 million from 3.6, is it? Then next year you have that 61 million top line. So growth is phenomenal. But again,
all you know, it's going to be high growth. Put it that way. It just depends on how high it is. So they really are absolutely flying. And another one, which again has done well, is Lords Group Trading, which is effectively that specialist building merchants plus sort of like a heating and plumbing division. And their demand, I mean, 80% of their sales is through repair, maintenance, and improvement of sort of like, properties and houses and stuff like that. And that's, that's going to, a lot of that is just going to carry on regardless of the economic conditions, because the UK housing stock is really quite dilapidated overall. And you still can't get plumbers and stuff like that at the moment. So the demand is still off the charts. The problem they have, which they talked about in the in their trading updates, is that they've got such strong demand, and obviously this is the other big macro issue to watch out for that Apple was suffering from, is that actually a lot of the supply chain still hasn't got back to normal, whether that's because of the Ukraine-Russia crisis, but now is more sort of like impacted by the Chinese lockdowns. But we come into, rather than Apple, come into sort of like Lords Group Trading, one of their sort of key product lines in their heating and plumbing division is boilers. And their suppliers, their OEMs, the likes of sort of like, Worcester Bosch and people like that, are struggling to actually get pumps for their boilers, and therefore to produce enough of these boilers for people like Lords to actually sell. So that has just sort of like hit their top line growth. But they make more margin, higher margin in their specialist building products business. So that's going to sort of like take it. And they're still on, for the profitability, they're going to be still on track overall. So actually, even though they came out with this sort of like, the news about their suppliers, struggling to supply them with the boilers, the shares didn't really move. And that's a good, overall sign, simply because, it says that the underlying growth and the strength of the market is there, but also as a sort of investment, philosophy for investors. It's sort of like, if there's a temporary sort of issue that's outside of its control, it will sort itself out. And therefore, don't throw the baby out with the bathwater type scenario. Why'd you sell a quality stock that's growing well with strong demand when, frankly, it's a short-term issue that will resolve? And that's really what's happened with Lords Group Trading. But they're a class act with good products and really, really run by an entrepreneurial management team and whole business that own a lot of shares. And, that's one of their real success KPIs, real success factors.
Mm-hmm. Yeah. Cool. And any other stocks there? Did we mention last time XP just an operations update on their boom battle bars, XP factory?
Yeah, is that getting on? No, I don't think we did actually.
Going very well. I mean, they started off, do you know what, they've been the RS up. They started off this year with literally, I think, 6 boom battle bars. 1 was owner operated, 5 franchisees, but they're on track for 27 this year, which is phenomenal. Escape Hunt is exceeding expectations, and so again, big growth there. It's hard to work. I mean, the brokers have got figures out there, but it's hard to work out actually. You can see that they're going to do 25 million in revenue for 2022. They did about 7 million for 2021, of course, again, but they were affected by the lockdowns. But yeah, it's hard. This is one I try to go individually because they're all opening at different times. It's really hard to understand, So you can only go
lots of moving parts.
But what is reassuring? They said the box economics of the business set up on, they're hitting those and exceeding on Escape Hunt, and in fact the mature sites are doing even better than they thought. So, and yet I think what's exciting is Oxford Street, which is going to be the flagship. It's like 15,000 square feet. Boom battle bar on escape rooms. It's going to be opening this quarter, and of course central London. It's a bit different from regions, like I said, because it can be busy. Sort of check out a lot of cash because it can be busy almost 7 days a week, rather than the regionals get more busy on the weekends. Of course, Oxford will be more busy on the weekends, but weekdays as well will be huge. And same with O2 and thing. But yeah, no, very exciting top line growth. But don't ask me. In fact, they've got no debt. But don't ask me for EPS on that. But no, if you want to go back to Space and People, I mean, the margins are good there.
It's all right, let's not go back there, mate.
7 million top line revenue. I mean, 10% profit margin there. Do that multiple on that. They're undervalued massively. They'll do a double here when people just realise it. Because even the broker though said we're going to wait till this first quarter goes by, or something else. Its first half goes by, then we reiterate guidance. Same with actually Emotion company. I don't own Emotion, but they're very good in the experiential fields. They do, some VR.
Yeah, VR, isn't it? Yeah.
Yeah. And I said that the guidance has been updated on that. They didn't have any guidance on that due to COVID, but again, they're growing at a good clip. And and that's the thing, is that with COVID stuff like this, when you get hit by COVID situations like a pandemic, what's it like going forward? Will they bounce back? And yeah, Emotion has bounced back. Spaceandpeople have bounced back. XP Factory has bounced back massively. So they can start seeing what's happening here. But I'll do my homework on Spaceandpeople. But again, they've got a bigger estate. It's hard to know.
Do it on Trufin as well, mate.
Trufin will be a unicorn. It's fine. Top line growth is phenomenal. The margins are fine. Listen, Satago will honestly, if it continues the way it's going, it'll be one of those British success stories software companies saying, wow, that's come from the UK. And in fact, a member of my investment club's brother created Satago and he sold it out in the end. It just, once you get these software companies, they take a lot of investment to get it going, to get it marketing. And he said, my ultimate dream was to get it in with a bank, a UK bank. And so
he's done it now. He's been out. Give him a pat on the back. He's done well. You can have a beer. Another company that actually put out a good statement, good RNS, is Amryt Pharma. Actually, amazingly enough, which their oleo gel for EB, the market had written it off basically, hence the shares had gone down. But actually, last week, just to me anyway, I know. Well, no. What happened was the European Medical Authority approved it. So that was fabulous news, and it will mean that it should go live. It'll be able to be marketed in the next sort of couple of months across the whole of Europe and maybe also the UK, even though it's outside the EU. So that was a major sort of pat on the back. The shares have picked up since then. And what that means is that there's now, my view, having, sort of like thought that the US wouldn't approve it because it wasn't, with regards to the efficacy, I think it's actually now got a decent chance. So 50% chance, maybe, I don't know what the percentage is, for the FDA to later approve it as well, given that the Europeans have approved it as, So, and I, when I come to do the sort of the valuation on it, I mean, the business is, even without oleo gel, the business is worth a shed load more because it's got like $250 million. It's having its results sometime next week, so I'll be interested to see what the outlook statement is. But you'll do $250 million of turnover this year, or probably even more than that. And the acquisition it made of MyCapsa, then that could do very well also as going forward, which is for the acromegalia condition. And so when you add all that together, the underlying business, excluding oleo gel, is worth a lot more than the current shares. And I think the oleo gel, I mean, that's $1 billion market worldwide. They could easily pick up 10, 15, 20% on that one because they're the only not drug in town, the only treatment in town at the moment. And on that basis, you could be adding another 100 million of turnover to that. So, I'm in plenty of upside. I was very surprised and very happy to see it. So again, a long-term hold, temporary issue that is worth sort of like, sticking with and just parking it and putting it away and see how it gets on.
Yeah. No, yeah, exactly. Sometimes you go there. Anything else?
Well, what have you done? What have you done with Polarean? Because I know you sold some of it. You said you sold some of it. Yeah, I sold
some of it. I mean, to me, Polarean, I mean, it's the news they've resubmitted their FDA, submission for their new drug application is fine. I mean, to me, that now, they've had collaborations with the FDA. Surely those issues that are outstanding have been covered. It'll take 6 months. Is it October? I think pretty much they'll get a reply within 6 months of September. So it may be earlier. I don't know, but I'm not going to make any decision on that. I've almost, it doesn't.
So you've still got the shares, have you?
Yeah, I still got shares, but it doesn't take up a major part of my portfolio. And I'm not going to take that FDA risk, even though there's probably more chance than getting it now. I'm sure because they covered up the issues. I'm just really wary on the FDA. So
I know they're a real sort of mind on their own, aren't they? At the moment, they sort of like just shoot by the hip.
Yeah. Just one other thing. Getech, which I own as well, is basically a play on the green hydrogen. Of course, they've got geospatial software, all that. But they've had sort of, their results. No growth there, but I'm hoping for growth to come, Paul.
Yeah, no, okay. Well, there you are. You just broke your rule there, mate.
Yeah. Well, why?
You've just proved against your own rule.
No. If I was in a court, I would say beyond reasonable doubt, there's going to be growth coming. I believe it. Growth.
Okay.
Can you prove that? And I'd say no. I believe it.
No. So you've invested on the back of what you think will happen, not. I'm waiting to see whether it does.
No, this is what I think, okay? Because they've got 21 agreements.
Yes, exactly. Yeah. You're like me, mate. You invest because you think this will happen.
For green hydrogen hubs, I pretty much know.
You've done the right thing.
Okay, let me say, Your Honour, he's cutting in here. I got to say, I think green hydrogen, I've got a good chance. I mean, looking at the industry and investment, government investment in green hydrogen, and the demand for net zero, I think it's going to be a major player in our economy going forward. And so having said that, Getech been involved in these green hubs. In fact, they've just announced this week, actually, SGN, the big gas network operator, are decommissioning their Inverness sort of gas network site and starting to create a green hub there. That's the first one. The groundwork is happening. And it's hard to value this company, like pretty much.
Exactly.
The broker came out with about 1.7 million of EBITDA on every project. They have about 20 sort of lined up. 3 now sort of close to be do work. The first one is Inverness, pretty much. But that's a bit of a hope. But I think betting on where the economies are going and decarbonisation, and in fact, soon I've got another company in the energy space. I think.
Oh right, this is where you're going to put some money in.
Yeah, well, if I can find some money, yes. But I've been looking at it, and I'll come to you with all the metrics.
Good man.
All right, well, stories are more interesting, aren't they? Stories. I mean, you got to look at the growth and the valuation and all that. But the story, if it's a macro hot trending story and it's sitting in the sweet space there, you think, wow, that's where's the upside there? There's no limit to hope, hype, potential. Trouble is, there is to figures.
Good to hear it.
Yeah. No, I think you've done good with the money supermarket there. But
all right, mate. We'll wait and see. I'll be eating my humble pie, I'm sure, going forward. No. And if I am, you'll remind me and beat me up about it, which is good. Hold my feet to the fire.
I will never do that. We never do that, really, because do you know why? Everyone takes hits on equities and investments. Like I said, no one gets it all right. And in fact, the good thing about investing is when you get it wrong, it hits you in the most painful place of ever. You go in to make money and it takes you away, does the opposite, it takes away money. So it hits you and you have to learn from that. And if you learn from that, you become a better investor. Doesn't mean we won't make a mistake in the future. We all take big hits, all of us. So there's no perfect investor. So anyone who says, oh, that went, that's the one thing I hate about Twitter. People sometimes enjoy other people taking a hit. Why? To me, that's a reflection of you as a person rather than my stock picking ability, because everyone takes hits, So, I will never, there's so many moving parts in investing. Anything can go wrong and anything can go right as well, So I've had winners where I didn't expect to have winners sometimes, So,
good.
No humble pie needed here, Paul.
Good man. All right. Well, I hope you have a good bank holiday. Make sure you do that homework, and I'll have a glass of champagne when you give me your thesis in 2 weeks' time. I'll mark it for you.
Yeah. Okay, cool.
Sorry for being a teacher. All right, mate. Have a great weekend.
Speak in 2 weeks.
Bye.